Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. I wanted to provide you with an overview of exactly how things lay in the wake of earnings season. Of course, now we come out the other side. Markets are starting to focus on other factors, most notably what's happening from a monetary policy standpoint. But I thought I'd take this moment to look back at how things set up and look at how things are expected to play out in the coming earnings seasons for the year ahead. Let's start off with the overview in terms of how things have landed versus expectations in terms of how many have reported. Well, 99% of the S&P 500 have now reported. You can see here that by and large, it's earnings that have outperformed versus revenues, whereas there have been a relatively mixed bag in terms of revenues. But I would say that earnings are by and large likely to be more important because that's profitability really, and it's all well and good growing revenues, but if you're not also managing to grow earnings, then that's going to be a problem. So profitability, a key concern in the wake of this massive boom in terms of inflation, and by and large they've been doing very well. Underperformers, you would say, would be sort of real estate and energy, but strength comes from across the board, really. Industrials, consumer non-cyclicals, technology, healthcare. But we will go into that in greater detail from here on in. So in terms of earnings growth from a wider perspective, so year on year, this is the fourth quarter earnings growth. What areas grew in Q4 compared to Q4 2023? Well, particular strength came from communication services, consumer discretionary, utilities, information technology. That's where the big strength came from. The downside came in terms of energy, materials, healthcare, financials. You can see in terms of the moves versus expectations, energy faring a little bit better than expectations. Financials in particular doing much worse than expectations, but it's really a broad spectrum of experiences within that sector. In terms of margins, this is an interesting one. You can see here that margins in particular fared much better than expected at 11.7. It came out in at 12.3. And of course, margins are absolutely key at a time when we've seen rampant inflation. The ability of businesses to take that inflation and be able to improve their margins rather than essentially just suffering from higher input costs. You pass on exactly that amount and you're back to square one. You're selling higher value products, but you're not necessarily gaining anything more for that. Well, businesses doing relatively well in terms of margins. And I thought this was interesting because we also have got expectations that this continues to grow over the course of 2024, in particular, the third quarter. It's where we've got expectations of 13.3 in terms of net margins for the S&P 500. In terms of earnings growth for the whole year for 2023, this is a lot more mixed. What you can see is 2023 has been incredible for the consumer discretionary stocks, around about 45%, 46% growth in terms of earnings versus 2022. Communication services, industrials also doing well. And then things start to become a little bit less pronounced. Their utilities, IT, real estate, financials, consumer. Most of them are positive at least, but healthcare, materials, and energy, the particular areas of concern, all of which saw earnings per share drop by over 20% compared to 2022. In terms of earnings per share growth, I thought this was interesting because we're looking ahead to, what if I show you the previous chart here, this is Q4 earnings growth in terms of how it's come in. But this is how we're expecting it going forward. And markets are expecting earnings to really ramp up over the course of 2024. Potentially, this is because of an expectation of economic growth as we see interest rates cut and governments potentially taking on a more growth-focused stance. But certainly, according to this, 2024 looks like it could be a good year for earnings growth. And of course, earnings are the kind of thing that underpins strength for equity markets. Crucially, part of the earnings per growth, or the earnings per share growth, has come from those big six tech names. Unfortunately, the Magnificent Seven appears to be the Super Six, as Tesla have been a big underperformer of late. But certainly it's worth noting, if you look at the bottom section of this, S&P 500 earnings per share growth, excluding the Super Six, minus 4.5. And in part, that's because of how heavily weighted these six stocks are in the index. But certainly it does show you that, in particular, Amazon and Nvidia have contributed a lot, and Meta, to driving up that earnings per share figure for the S&P 500 as a whole. And without it, it certainly doesn't look as healthy. This is the trajectory over 2024 thus far for those so-called Magnificent Seven. You can see it's very much been a mixed bag. Nvidia, of course, the big outperformer. Meta also faring very well, but that comes off the back of a greater decline that we had seen previously, a big recovery play there. Tesla, the sick child in the group, and Apple and Google also fading most notably in recent weeks. Amazon, Microsoft, both in positive territory, but you would say that they're taking a more cautious and gradual approach, which is to be expected. They're not necessarily going to see the same kind of gains that we're seeing for Nvidia, which is seeing an absolutely massive AI boom at the moment. In terms of the expectations for S&P 500 earnings growth, this is where you would expect the strength to be, or where markets are expecting the strength to come in. IT heading it up, communication services, so big tech names expected to once again outperform over the course of the year, with the biggest earnings growth in 2024. But healthcare expected to stage a significant bounce back. Financials also expected to do well. S&P 500, you're expecting 11% earnings per share growth over the course of 2024. That's down from 11.5 expectations at the beginning of the year, in part because we've seen earnings actually outperform market expectations already. Consumer discretionary, utilities, industrials also doing well. Energy and materials, once again, the two areas of weakness. But this is likely to really just reflect the trajectory of the underlying assets, the commodity prices in particular. And so if we did see a ramp up in those commodity prices, then you're likely to see these stocks fare better, because the expectations and the estimates for their earnings will increase as a result. And then this is the change in sector level earnings per share for 2024. So essentially, previously we had what the expectations is on a sector level for 2024. Now it's how have those changed, those expectations, who's gained most over this period, and who has suffered most. Well, expectations for energy and materials have deteriorated even further. Consumer discretionary and communication services and IT have improved further, in part down to sort of better than expected earnings data, and a little bit more of a mixed bag, but generally towards the downside elsewhere. You can see for the S&P 500, we have got that downside move in terms of expectations, minus 0.3. But as I alluded to, that comes in part down to the idea that some of those earnings are potentially being brought forward to tempers expectations. In terms of the trajectory of the different segments of the S&P 500, the different sectors, you can see here, let me just get rid of my head just so that you can see this in greater detail. Essentially, you can see that information technology, the big outperformer, has been sort of seeing some jitters of late, but still strong. Telecommunications also starting to fade recently, but a particularly strong start to the year. The bottom end, you can see utilities and real estates staging a comeback. So we're seeing a sort of narrowing coming in play here. So the big outperformers, in particular, telecoms, information technology, starting to weaken somewhat of late, and the big underperformers, the likes of real estate and utilities, staging a catch-up play at the moment. So the moves that we're seeing within markets, in terms of some of the jitters being shown in markets recently, despite the fact that markets move towards the upside, well, the weakness we're seeing in some of these tech stocks are being overshadowed by some strength of some other areas that you can see on this chart, in terms of materials as well, moving towards the upside, consumer staples as well. Here is a chart showing the three major indices over in the US. The Dow, that is the big underperformer here since we've seen the beginning of this year, 2.66% up. Nasdaq, the outperformer, but we're seeing some big swings recently. And really that highlights some of the jitters we're seeing within the tech sector at the moment. But certainly if we're looking for the market to be long at the moment, you would say the S&P 500 and the Nasdaq look a better bet. They have the stronger trend in play at the moment, and the Dow somewhat lagging, as you can see there. And finally, before I just bring up a couple of live charts here, I also loaded this chart, which is the Nasdaq on the top end, the S&P 500 on the bottom end, and beneath each one we have the proportion of the index that is trading above either the 100-day SMA or the 50-day SMA. Generally, the 100-day SMA line will only decline when you've seen a protracted period of downside or a particularly sharp period of downside for that index. We haven't necessarily seen that because we're seeing these stocks, these indices gain ground. What's notable is that the Nasdaq number of stocks above the 50-day high is now around, it's just moved higher, but on Tuesday it was at 50%. So half of the index trading below the 50-day moving average. So it shows that some of the heat is really coming out of the Nasdaq. It continues to push onwards and upwards, but that could be a little bit of a warning sign of further weakness over the near term. Let me just finally wrap this up by showing you the S&P 500 and the Nasdaq on their own and point towards exactly how a trader might play this. Now, ultimately, you're looking at, this is the 4-hour chart, you're looking at a very established trend. You're looking at also a market that keeps reaching record highs. So the trend is your friend and it moves towards the upside. Every once in a while, you'll get a pullback. And so it's a case of being able to ascertain, what would it take to negate that pullback? Well, it would take a breakdown through the price swing low. On this occasion, the price swing low, you would say, is this 49.20 up to 49.46. Over the very near term, you'd be looking at this support level that we have at 50.57, and that has been tagged, and now we've sort of bounced off that level. But I would say as long as price remains above 49.20 to 49.46, then near-term downside for the S&P is likely to be bought up. A different way of doing it, rather than drawing on your own horizontals, is to use the Donchian channel. This has its benefits and its downfalls. Essentially, the downfall is that, if you have a protracted period of consolidation, that swing low still remains in play. But because you have to choose an amount of candles for it to hold on to the price swing low, that swing low will start to drop out over time. You're seeing this at the moment with this sharp rise. That swing low still holds, but we are seeing a rise coming into play here. So ultimately, if you're looking at a chart and you want to see whether it's trending or not, one way is put the Donchian channel on and see whether you're seeing this stepped move higher, and the same on the top end. So this market very much in an uptrend, and as long as we don't break through that support structure, I think near-term downside is unlikely to last too long. A similar kind of picture for the Nasdaq. Like I said, we are seeing the sort of underlying breadth metrics starting to weaken somewhat. So we could come into a deeper pullback. As long as we don't break through this 17128 up to 17313, that zone, then near-term weakness is likely to be bought into. This is the Fibonacci retracement tool. I'm just going to put on a few of these deeper fib levels. Essentially, if we manage to break down into this zone, that looks a particularly interesting area for bulls. We don't often get deep retracements. You might get mid-sized retracements. This looks kind of like a 50% retracement. But from there on in, this is probably a 38.2 retracement. This is a nice deep retracement. When you get those deep retracements, they can be advantageous because essentially you'll be able to buy in on the cheap, so to speak. You're waiting for a pullback within the trend and looking for that trend to continue. If we break down through this 17319, then it looks like this trend's going to roll over or take a breather. But ultimately, until that happens, near-term downside is likely to be bought into by the bulls.